Just a few hours, the Federal Reserve is expected to raise its benchmark lending rate after a pause last month. Joining us now for the impact for the markets, Komal Sri-Kumar, the aforementioned gentleman, president of Sri-Kumar Global Strategies. Also, Barry Knapp, Ironside's macroeconomic director of research. Both of you, I think, watch the show when you can. Sri, you watch it when you can.
Yeah, I watch it. I mean, it's middle of the night for me in California, but I do watch your show.
Oh, you can DVR it or whatever. Then you know. One thing that's been getting me is if we go today, and then let's say we do a couple, but let's say we do a couple more. We're getting further and further away from where the 10-year seems anchored, and it just gets crazier and crazier and harder to explain why bond market participants are so far from where the Fed is and where it's going. We're just going to get further away. What does that mean? Is the Fed going to finally capitulate, or are the markets going to finally catch up with the Fed?
I think eventually, Joe, the Fed has to capitulate, but it may not be today. Today, my expectation is that they are just going to be talking about a quarter-point raise. And Powell has a very divided Fed. Keep in mind that even though in June they agreed to pause, it was not really a unanimous decision. You had people who wanted to increase, people who wanted to stay still. And so he's going to have a hard time explaining it at his press conference today. That's the first one. Second, inflation is not yet conquered. Whether you look at the Fed's favorite index or the CPI or the one we are going to get on Friday, it's going to be well above the Fed's target. And at these kinds of low levels, inflation has a tendency to go down, and then if you take the foot off the brake, it is going to start going up again, and that's the risk that they run. You asked about the 10-year. The 10-year is reflecting the fact that a recession is coming. So which is why anywhere like 3.8 on the 10-year is a very good value for the investor, because as I've been saying to you in the past discussions, I think the 10-year is headed toward the 3%.
The 10-year is coming no matter what, or the Fed is going to keep going until it gets what it wants. Well, I don't know if it wants a recession, but it's going to keep going until it causes a recession?
They will probably not keep going repeately. They paused.
But they've done enough already?
Again, but eventually they'll have to keep increasing again until the inflation rate comes down or something breaks in the system. Which comes first?
Barry, do you agree with all that, or you have opposing viewpoints? Do you think that a recession is in the cards, and that's why the 10 years where it is? It's coming no matter what.
Not really. I think we're actually in an earnings and gross domestic income recession, which may very well actually be ending. I think there's some element of the Fed's policy is too tight that is embedded in the 2s, 10s, deep curve inversion, particularly if you look at the TIPS curve or the real rate curve, which is probably a better reflection on Fed policy. The magnitude of the inversion we've only seen 3 other times in post-war history: October of 73, December of 79, and December of 80. And those were obviously followed by very deep recessions. So, I Shree's onto something with respect to that. But the other element here, and the reason that the 10-year is so anchored and so low relative to the front end, is the Fed's balance sheet. They own a third, roughly, of the Treasury market, mortgage market, and TIPS market. That term premium, which is a measure of how much risk you take on to hold those longer-term securities, is almost negative 1%. And so if the Fed were doing this tightening differently, were more aggressive with QT and less passive, then they would probably be getting better results on inflation with respect to the housing market, for example. So, I think part of that deep curve inversion, which, by the way, is an existential threat to small banks, not to JP Morgan, but to small banks. And we saw that PacWest finally had to capitulate. They've been selling off high-quality floating rate asset portfolios, doing anything they could to shrink because they can't operate in this deeply of an inverted curve environment. So, that's, to me, that's the real risk out there, is that the banking system just can't deal with this deep a curve inversion.
Sri, the stubbornness of inflation is, we had Kaplan on, former Dallas Fed president, said that there's still a lot of money left to spend. I thought most of the pandemic related relief that was gone. That might be gone, but the infrastructure bill and the IRA, we're just getting started on that stuff. And if you're hiring people to do that stuff, and we see what's going on with Teamsters and UPS, that's where a lot of it is, I guess.
Exactly. A lot of fiscal stimulus is still around in the second half of 2022, which is the Fed Reserve's time period. They saw that at somewhere in the range of $1.5 trillion of excess savings, Joe, in the hands of the public. And that is what is causing the market to remain so strong, even though, as Barry said, the yield curve has been inverted now for a year, the 2 to 10 curve. But the 2 to 10 curve is clearly a no-fail mechanism for predicting recessions in the past. My expectation is that the recession is delayed but not denied. So I think that's where we are right now.
2025, is that the clear time? Because, again, I keep hearing people who are in trouble with commercial real estate, who have things coming due. I think their hope is if they can just make it to 2025, it'll be a better picture, rates will come down, and then they can, refinance on some of those deals that they're involved in. You think that's the case?
If you can survive through 2025 in the commercial real estate area, Becky, you are in good shape. Question is, will you survive as long as that? I think interest rates may be coming down before the end of this year because I expect something to break in the system. You mentioned commercial real estate, which is one of my top candidates. The other is, once again, a regional banking crisis, because a good chunk of their assets are underwater. And if you have the Fed continuing to increase interest rates, that's going to put even more pressure on the assets. And I think that's where the risk may come as well. And thirdly, a credit crunch with the high interest rates and credit not available. And that in turn causes problems which the Fed cannot foresee at the moment.